Hello everyone, this week we are going to learn GDP and the income of a country. This chapter is called Measuring a Nation's Income. Microeconomics is the study of how households and firms make decisions, interact in markets. Macroeconomics, on the other hand, study of economy-wide phenomena. So if we talk about inflation, unemployment, economic growth, these are the terms that affects everybody living in the country. Then we talk about macroeconomics. Microeconomics is the decision making of households, firms, customers, and so on. So in this class we are learning macroeconomics, and the first term that we need to know is income and expenditure. Let's start with GDP, which is gross domestic product. GDP measures total income of everyone in the economy. It also measures the total expenditure on the economy's output of goods and services. Let's see this example. Let's say you have $1, right? When you spend $1 on Starbucks, then it becomes income for the Starbucks, right? Because income, this $1 in Starbucks is a profit. Some of it is profit. Some of it pays as a wage. Some of it is used to buy ingredients. And some of it goes to leasing the store and so on. So as you see, expenditure, spending, turns out to be income for everybody in the economy. Income equals expenditure for the economy as a whole, because every dollar a buyer spends is a dollar of income for the seller. Now let's see this example. Nala pays James $50 to mow her lawn. What happens with total expenditure? Total expenditure is going to increase by $50. Why? Nala's spending is increasing by $50. What happens with total income? This expenditure is an income for James. Therefore, total income increases also by $50. Next, I want to talk about circular flow diagram. This diagram is important to understand how the expenditures and income moves along in a cycle in the economy. It's a very simple depiction of the macroeconomy. Illustrates GDP as spending, revenue, factor payments, and income. For a preliminary knowledge, you need to know factors of production. Factors of production are inputs of production like labor, land, capital, and natural resources. Factor payments are payments to these factors. Like for instance, labor payment is wage. Land payment is rent, and so on. We have two main agents, households and firms in the economy. And households own the factors of production. So that means you look for a job, you have the labor hours, so you supply factors of production to the market. And in return, with the money, wage they earn, they buy goods and services. Firms buy or hire factors of production. So factors of production market, firms are buyers, households are suppliers, and firms use these factors of production to produce goods and services. In the goods market, firms are seller of goods and services, and households are buyer of goods and services. So we have two markets, factors of production market. In factors of production market, as I said, households are seller. They have the labor, land, and capital. And firms are paying wages, rent, and profit, and this becomes an income for households. And with that income, households go to the markets for goods and services. They spend money, and that money is equal to their income, and that becomes a revenue for the firms, and in return, firms supply goods and services to households. So what this diagram omits? The government. Government collects taxes, buys in goods and services. Financial system is missing. Financial system matches savers' supply of funds with borrowers' demand for loans, and the foreign sector is missing. Trades goods and services, financial assets, and currencies with the country's residents. So now let's look at the definition of gross domestic product. The definition of GDP can be tricky, so please pay attention to the highlighted words in the sentences. The first three highlighted words are the market value of all final goods and services produced within a country in a given period of time. Goods are valued at their market prices, all goods measured in the same units, let's say dollars in the United States. Things that do not have a market value are excluded. For instance, housework you do for yourself is not included in the GDP. So everything that you sell or buy has to have a market value, otherwise it's not going to be in the GDP. Let's look at this example and understand which country is producing more goods. Country A produces 100k pounds of oranges and 1 million cars. Country B produces 100k pounds of oranges, the same, 1 million chairs. So in terms of quantity, they produce the same quantity, right? 100k pounds of orange and 1 million cars, 100k oranges, 1 million chairs. But do they have the same income? It's a big no. Why? Because we need to calculate the market value. Since cars are more valuable than chairs, country A's income is much higher than country B's income. The next highlighted word is all. The market value of all final goods and services produced within a country in a given period of time. GDP includes all items produced in the economy and sold legally in markets. GDP excludes most items produced and sold illicitly. It also excludes most items that are produced and consumed at home. Given this, for instance, if you make a soup for your friend and then ask your friend to come over, the soup that you make, the value of the soup is not included in the GDP. But if you actually buy the soup and take it to your friend's home, then the value of soup is included in the GDP. So anything that you made at home is not included in the GDP, but everything you buy and have a market value are included in the GDP. Another example, let's say one of your friends buys marijuana in Texas. Marijuana is not legal in Texas, so that transaction is not included in GDP. But the same friend can buy marijuana in, let's say, Colorado, which is legal, sale is legal, then it's included in the GDP. Now, the highlighted word is final. The market value of all final goods and services produced within a country in a given period of time. Final goods intended for the end user, intermediate goods used as components or ingredients in the production of other goods. Final goods, for instance, the milk that you buy from the market for your consumption at home is a final good. But if Starbucks buys the milk and use it as an ingredient in the coffee, then the milk becomes intermediate goods. Intermediate goods are not calculated in the GDP. Final goods are only included in the GDP. The reason is simple. If you include the intermediate good and the final good after that, you double count the value of the good. For instance, Starbucks buying milk, if you count the value of milk plus the value of the coffee, which coffee includes the value of the milk, then you double count the value of milk in the GDP. For that reason, the value of coffee included in GDP, but not the intermediate good, which is milk in this case. GDP only includes final goods. They already embody the value of the intermediate goods used in their production. So let's see this example. Write an F or I for the good or service listed below. Bread is a final good. Flour for making bread is an intermediate good. Cloth for making dress is an intermediate good. Dresses final good. Manicures final good. Glass in new automobiles is an intermediate good. Lumber in a new house, intermediate good. Now the next two words highlighted are goods and services. The market value of all final goods and services produced within a country in a given period of time. GDP includes tangible goods like food, mountain bikes, beer, and GDP also includes intangible services like dry cleaning, concerts, haircuts, or accounting services, doctor visits, all are included in GDP. So let's see this example. Which of the following should be added to GDP? Buying a car, renting a car? The answer is both. Renting a car is a service, buying a car is a good, so goods and services are included in the GDP. Now the produce is highlighted. The market value of all final goods and services produced within a country in a given period of time. GDP includes currently produced goods, not goods produced in the past. So one example, which of the following should be added to GDP? Buying a used iPhone from eBay, buying a new iPhone. So buying a new iPhone is included in GDP. Why? Because used iPhone, when it's produced and sold as a new, it was included in that year's GDP. If you include a used iPhone in today's GDP, you are double counting the value. The market value of all final goods and services produced, this time within a country, is highlighted in a given period of time. GDP measures the value of production that occurs within a country's borders, whether done by its own citizens or by foreigners located there. Let's see one example. Which of the following should be added to GDP? A Ford car produced in India, a Honda car produced in Texas. So geographical proximity is important for GDP. Everything that has to be produced in the country in order to be counted in GDP, doesn't matter the nationality of the company. So a Ford is an American company, but it produces in India, therefore it's not included in the GDP of USA. A Honda car, on the other hand, although Honda is not an American company, it's produced in Texas, it is included in the GDP. So in a given period of time is highlighted. The market value of all final goods and services produced within a country in a given period of time. Usually GDP is measured for a year or a quarter. So let's see this example. What is included in GDP? Nala pays James $50 to mow her lawn. What happens with GDP? Since James is doing this for an income and there is a price, then GDP is going to increase. This is a service, and GDP is going to increase by $50, the value of the service. Will your answer to the previous question change if Nala and James get married? Yes, then James is going to do this for the family and there is not going to be exchange of money. Therefore, anything that's done in the house and doesn't have a market value is not included in the GDP. If they get married, the value of this service is not going to be included in the GDP. Now let's look at the components of GDP. GDP is total spending, but we can divide into four main categories. Consumption C, investment I, government purchases G, net exports NX. So GDP is usually denoted by letter Y. GDP Y is equal to C plus I plus G plus NX. Let's start with consumption C. Consumption is the total spending by households on goods and services, does not include purchases of new housing. Why? Because new housing is considered as an investment in the economy. Except buying a new house, everything that households buy are called consumption. Note on housing costs for renters, C includes rent payments. So if you pay rent, then consumption includes rent payments. For homeowners, C includes the imputed rental value of the house, but not the purchase price or mortgage payments. So if you own the house, then you assume that if you rent this house, how much you earn should be included in C, but not the purchase price or mortgage payments. The next one is investment I, which is the total spending on goods that will be used in the future to produce more goods. So this is a tricky part. Investment doesn't include stocks and bonds in economics. Investment includes total spending on goods that will be used in the future to produce more goods. For example, business capital, business structures, equipment and intellectual property products. Residential capital, landlord's apartment building, a homeowner's personal residence. Inventory accumulations, goods produced but not yet sold. Let's say this year Ford produces 100K cars but only could be able to sell 50K of them. The 50K goes to inventory. Inventory accumulations are also considered as investment. Investment does not mean the purchase of financial assets like stocks and bonds. Government purchases G. Government purchases are all spending on the goods and services purchased by the government. It can be at the federal level, state and local levels. But government purchases excludes transfer payments such as social security or unemployment insurance benefits. Why these transfer payments are excluded? The reason is very simple. You collect tax and you transfer this tax from one person to the person who needs it. They are not purchases of goods and services, therefore these transfer payments such as social security and unemployment insurance benefits are excluded. Net exports are defined as exports minus imports. So let's define exports. Exports, foreign spending on the economy's goods and services. So Apple phone bought by a European is called an export. Why? The company, Apple, is a domestic company selling a good to a foreigner. Imports are the portions of C, I and G that are spent on goods and services produced abroad. So imports can be French wine. It's produced by France and then bought by a domestic is called import. And net exports is the difference, export minus import. Adding up all these components gives the GDP, which is Y is equal to C, consumption spending plus investment spending plus government purchases plus exports minus imports. So here is US GDP and its components by 2018. US GDP is almost 20 trillion and per person 62,000. Consumption 13.9 trillion. Most of the GDP comes from consumption goods, almost 70%. 3.6 trillion, 17.8% is investment, 3.5, 17.2% is from government, and as you see, net exports are negative. That means we have more imports than exports. Remember, net exports is exports minus imports. If this number is negative, that means we have more imports than exports. So let's see this example. What is the effect on GDP and its components? Yazara spends 300 to buy her husband dinner at the finest restaurant in Boston. This is a consumption, right? Because a household spends in a restaurant is a consumption. Consumption is going to increase. Therefore, the GDP increases. Remember, Y is equal to C plus I plus G plus net exports. C increases, therefore GDP increases. Second example. Nala spends 1,200 on a new smartphone to use in her publishing business. The smartphone was built in China. So let's understand this. Remember, GDP doesn't include any goods that are produced outside of the country. But we know that this is an import, so it's going to affect here exports minus imports because it's produced by China. This is going to increase. But since at the same time, this is 1,200, it's an investment for her business, this side increases too. As you see, both sides cancel each other because imports are negative, investment is positive, and then for that reason GDP doesn't change. So we know that GDP doesn't change when something is produced in outside of the country. And now with that example, we see that although imports are increasing 1,200, it is also an investment for her business because she's going to use that smartphone in her publishing business. And these transactions cancel each other and we have no change in GDP. Let's look at C. Joseph spends 800 on a tablet to use in his editing business. He got last year's model on sale for a great price from a local manufacturer. This doesn't going to be included in the GDP. Why? Because anything that's produced last year is not going to be this year's GDP. So no change. GM builds 500 million worth of cars, but consumers only buy 470 million worth of them. So how we are going to do this? Y is equal to C plus I plus G plus NX. And we know that C is going to increase by 470 million because consumption increases by that much. And the remaining 30 million is going to the inventory, therefore investment is going to increase. So the total increase in the GDP is 500 million. 30 comes from investment, 470 comes from consumption. You can find the answers here. And now let's little bit talk about GDP per capita and GDP growth. What is GDP per capita? Find GDP of USA and China. Find GDP per capita of USA and China. What is GDP growth for both countries? So I want you to pause this video and think about these questions for a while, and then we will talk them in the next slide. GDP 2022. Let's find first US GDP in 2022. I'm using my cell phone and Google. US GDP in 2022, Google says 20.94 trillion. This is US. And now let's find China. China GDP is 14.72 trillion. So as you see, the biggest economy in the world is US in terms of GDP. And the second one is China. But the next question is, do they have a similar living standards? Do they enjoy the same income? So by looking at just GDP, we cannot make that decision. Why? Because this part, this GDP is produced by 320 million in US, but this if you think about it as an economic pie, big pie, is produced by 1.5 billion people in China. So in order to make the comparison in terms of living standards, we need to check the GDP per capita. Let's find GDP per capita for both countries. USA GDP per capita is 63.5k and China is 10.5k. You see, when you divide the GDP, the total pie, equally among the citizens living in the country, how much each of them gets. So this is an equal distribution. This doesn't mean that everybody is going to get 63.5. But if I want to compare the countries and I want to know what each person earns per capita means per person, how much income they get, that is for 63.5 for US and 10.5k for China. As you see, China's number is lower. That means living standards are different in both countries. US enjoys a better living standards compared to China. And finally, let's look at the GDP growth. USA GDP growth. Unfortunately, because of the things happening in the economy, US GDP growth now is negative 3.5% in 2022. And we can do that for China, 2.3%. China's growth rate is going down too. Usually China grows at 7-8% and US grows at 2 to 3%. Because of the COVID, we have a negative growth rate for GDP, for US, and for China. It's positive, but it's a small number. Now, the next topic we will talk about is real versus nominal GDP. Nominal GDP values output using current prices, not corrected for inflation. Real GDP values output using the prices of a base year and is corrected for inflation. For the base year, both nominal and real GDP are equal to each other. We need to do an example to understand nominal GDP and real GDP. Let's first calculate the nominal GDP in each year. So in each year, we produce two goods, pizza and chocolate. And we know that GDP is the sum of the value of the two goods produced in that country. So each pizza is 15 times 300. Each chocolate is 2.5 times 1000 is going to give the nominal GDP for 2019. So 2019, 15 times 300 plus 2.5 times 1000, 7000 is the nominal GDP. In 2020, we again use the current prices. Remember, this year's prices times quantity, price of the chocolate in 2020 times the quantity. And that is 10,000. And 2021, it's 17 times 500 plus 3.5 times 1,300, $13,050. So when we look at the nominal GDP increased from 19 to 20, 42.9%. And nominal GDP increased from 20 to 21, 30.5%. Now let's calculate the real GDP and assume that base year is 2019. So that means when I calculate GDP for 20 and 21, always I use the price 15 and I use the price 2.5. So I keep the prices constant. I just want to see how many more units we produce over the years. So for 2019, it's 15 times 300 plus 2.5 times 1,000, 7,000. As you see, when we calculate the base year nominal and real GDP, you realize that they are equal. Now 2020 is different. Look, price stays same, don't change. We are not using 16. We refer to the base year prices, but quantities are from 2020 times 400. Again, the price of chocolate stays the same, but the quantities are from 2020 and real GDP is 9,000 for 2020. For 2021, again, the prices are constant, but the quantities are changing. 2021 quantities we are using to calculate real GDP 2021. So since we don't count the change in prices, the increase in real GDP should be less than the increase in nominal GDP. As you see, from 19 to 20, real GDP increases 28.6%, and from 20 to 21, real GDP increases 19.4%. So the change in nominal GDP, as you see here in numbers, includes the change in both prices and the quantity. But for real GDP, price is fixed constant, therefore we look at only the change in quantity. So for that reason, the increase in nominal GDP is much higher than the increase in real GDP. 42.9% compared to 20-something in real GDP. The change in real GDP is the amount that GDP would change if prices were constant. That means there's no inflation. And here, the increase in real GDP from 19 to 20, 28.6%. Hence, real GDP is corrected for inflation. Now, you can see one graph that is from Federal Reserve in St. Louis, FRED database. It shows the nominal and real GDP in the US 1965 and 2019. As you see, nominal GDP is represented by the blue line, real GDP is represented by the red line, and the gray shaded areas represents the recessions. And one recession that is here, we had it recently, is financial crisis of 2008-2009. As you see, both of them goes down in that period. Now, the next statistics we need to learn is the GDP deflator. GDP deflator is used to measure the prices. So in GDP deflator, you keep the quantities constant and you just focus on the change in prices. How do we calculate GDP deflator? It's 100 times nominal GDP divided by real GDP. It's a measure of the price level, measures the current level of prices relative to the level of prices in the base years. And GDP deflator is used for economy's inflation rate, compute the percentage increase in the GDP deflator from one year to the next year, gives us the inflation rate. Inflation rate in year 2 is the difference of GDP deflator in year 2 minus GDP deflator in year 1 divided by GDP deflator in year 1 times 100. Now let's calculate the GDP deflator in each year. We need to get first 100, nominal GDP 7,000 divided by real GDP 7,000, GDP deflator is 100. For the base year, always GDP deflator is 100. Why? Because nominal GDP is equal to real GDP for the base year. 2020, now get to nominal GDP 10,000 from 2020 divided by real GDP 9,000. It is 111.1. 2021, 100 times get nominal GDP 2021 13,050 divided by real GDP 2021 10,750, it's 121.4. So you can see the inflation rate here, right? From 100 to 111.1, the inflation rate is 11.1%. The prices increase on average 11.1%. And if we calculate the inflation rate from 20 to 21, what we are going to do, we will take the GDP deflator 121.4 minus 111.1 divided by 111.1 times 100, we will find 9.3 is the inflation rate from 20 to 21. Now we have an example here. First, pause the video and try to solve on your own, and then in the next slide I will show you how to solve it. Okay, welcome back. Now compute nominal GDP in 2019. Let's do it together. Compute nominal GDP in 2019. We have cookies $1 each, 900, so $1 times 900 plus $900 smartphones times 185. That is going to give us the nominal GDP for 2019. Let's look at here. We can check the answers in the following slide. Compute real GDP in 2020. We are going to get the quantities from 2020, 1,000 cookies, but prices are going to be from the base year, $1. Plus again, the quantities are from 2020, but prices are going to be from 19. That's how we calculate the real GDP. And how about the real GDP deflator in 2021? We need nominal GDP in 2021 and we need real GDP in 2021, and their ratio times 100 is going to give us the GDP deflator in 2021. So nominal GDP in 2019 is 167,400. Real GDP in 2020 is 181,000. And finally, we need the GDP deflator in 2021. For that reason, we need nominal GDP in 2021, which is 255,750, and real GDP is 190,250, and their ratio times 100, which will give us 134.4, is the GDP deflator. So real GDP per capita, main indicator of the average person's standard of well-being, as we talked about it in the previous slide. But GDP is not a perfect measure of well-being. Let's look at Robert Kennedy's speech on GDP. Gross domestic product does not allow for the health of our children, the quality of their education, or the joy of their play. It does not include the beauty of our poetry or the strength of our marriages, the intelligence of our public debate, or the integrity of our public officials. It measures neither our courage, nor our wisdom, nor our devotion to our country. It measures everything, in short, except that which makes life worthwhile, and it can tell us everything about America except why we are proud that we are Americans. So, given this speech and the definition of GDP, we know that GDP does not value the quality of environment. Leisure time. Why? Because if you work hard, GDP increases, but there is no value to leisure time. There is no monetary value. It has a value for you, but there is no monetary value, therefore it's not included in the GDP. Non-market activity, such as the child care a parent provides at home, is not included in GDP. Volunteer work is not included in the GDP. And also GDP doesn't include an equitable distribution of income. So GDP is a good measure of economic well-being for most, but not all purposes. So you are going to discuss imperfections about GDP measurement in your discussion this week. You can watch a video about why do we care about GDP here. Having a large GDP enables a country to afford better schools, a cleaner environment, and healthcare. Therefore, GDP is a good measure, but is not a perfect measure. Many indicators of the quality of life are positively correlated with GDP. For example, higher the GDP, the higher the life expectancy. Look at the countries that has higher GDP. Japan, Germany, United States have life expectancy around 80 years old. The higher the GDP, the more schooling. Average years of schooling for high GDP countries compared to the low GDP countries. And overall life satisfaction. Higher the GDP, the more life is satisfactory. Look, Japan, Germany, United States compared to other countries that have lower GDP. So this is the end of this chapter. You can read these questions and think about these questions. Thank you.